What's up everyone, Conrad Neufeld here, and today we're going to be talking about how to add in renovation costs into your mortgage. We're going to talk about how to add in future renovation costs in the event that you're buying a home, but it's just not quite right. Like maybe you need to reshingle your roof, or maybe you're looking for a remodeling of a bathroom or a kitchen, or maybe you're looking to do just some simple touch-ups. But we're also going to talk about how to add in renovation costs once you already own the home as well, because some of the nuances and rules around how you can do that can be a bit tricky, and as a result, sometimes require a little bit of creativity to pull off. Okay, let's first talk about how to add in future renovation costs into a mortgage on a home that you don't already own yet. And the reason why I want to cover this first is because a lot of people simply don't even know that this is an option, that this exists. And what it really allows you to do is look for homes that are close-ish to perfect. Maybe you found a home that's pretty close to what you're looking for in a neighborhood that you absolutely love, but the home needs a little bit of updating or fixing up or some improvements before you feel comfortable moving into that house. The type of mortgage that you're looking for in this case is something called a purchase plus improvements. It's called that because you're purchasing plus you're adding improvements. Now, the first thing that you need to understand is with this particular mortgage program is that there are some limitations. This program is not intended for you to take it and add in an entire floor to the home. In fact, if you're looking for renovation costs upwards of $80,000 or $100,000 in order to do something like that, then that would be called a construction mortgage. And that is entirely different and separate from the topic of this video, and I'll cover that in a future video. What these purchase plus improvement mortgages typically cover is about 20% of the value of the home, or $40,000, whichever is less. Now, there are exceptions that allow you to go slightly above this, but this is handled on a case-by-case basis. And generally speaking, what the lender is looking for is some comfort knowing that the renovations that you're adding, these improvements that you're adding to the mortgage, are actually adding the same amount of value to the house or greater. Because if, God forbid, in the future you end up in a situation where you can no longer afford your mortgage payment and the lender has to take your house, they want to make sure that you are not underwater on your mortgage, meaning that you don't owe more of a mortgage than the home is worth. And one of the ways that they can do that is making sure that the improvements that you're adding are actually adding the value that you think that they are adding. Another limitation of this program is that once you take possession of the house, you have approximately 90 days within which to complete the improvements that you've indicated to the lender. And this is in spirit of the program. I mean, the program is intended to help make a home that's close to perfect and help use these improvements to make it livable. If you can take these improvements and do them a year from now or 2 years from now, then it would also be argued that in theory, that home is already livable, or at least livable enough that you're okay pushing off these renovations. Now, not everything goes according to plan, so sometimes the 90 days isn't quite enough. And sometimes not everything can be done within those 90 days either because of some kind of seasonality, for instance, maybe the pouring of a garage pad. If that's the case, there are times and cases where exceptions can be made to this 90-day rule, but you should never rely on them. You should always, if you can, make sure that they're done within the 90 days because they're always approved or not approved on a case-by-case basis. This program also has limitations as to what kind of improvements and renovations can be added to the mortgage in the first place. The biggest rule of thumb that you can take away from this is that lenders typically want to see things that improve the value of the property and are affixed to the property itself. So if you go in and you add things like cupboards and an island to the kitchen, those are renovations that are likely going to be improved. But if you're looking to add things like appliances like a stove or a fridge, those will almost certainly be declined, because stoves and fridges in the past have had an inclination to grow legs and walk away. So the lender wants to know that the mortgage that you're giving you is actually financing things that are going to be attached to the property itself. Now here's where it gets a little bit tricky for people. In order to know what you can and cannot and how much you can build into as far as renovations and improvements are concerned, you need to present to the lender an itemized quote detailing not only all of the work that you're looking to do, but the full cost of the work that you're looking to do. And the lender needs to be able to approve this before possession date. They need to know exactly what you're trying to accomplish and how much it's going to take in order for you to accomplish what you're trying to do. And that is a good thing, because what it allows the lenders to do is set aside the appropriate funds so that they can fund the full cost of your renovations. And often they'll do it without impacting your mortgage rate as a whole, and those renovation costs will often be the same rate that you get on your mortgage as well, which is far less than any home equity line of credit or credit card would otherwise be in order to fund those renovations if you were to do it through those methods. Now, if you're in a situation where the improvements that you're looking to build are absolutely critical to the purchase of your house, in other words, you're just simply not going to purchase this house unless these improvements are done and you can build them into your mortgage, then it's strongly advised that you start working on those quotes as soon as you start putting in the offer to the place. And more importantly, have the lender review those quotes before you remove your condition of financing, which is the date that you have to prove that you can get financing for the property that you're looking to purchase. Whatever you do though, make sure that you're putting enough attention into the quotes that you're getting drawn up, because lenders are going to hold you relatively closely to those quotes. If, for instance, you say, hey, I'm going to renovate this place, I'm going to remove the windows, and I'm going to add triple pane windows, it is not an acceptable alternative to halfway through the renovations change your mind and say, hey, I'm going to save on costs. Instead of triple pane windows, I'm now going to install double pane windows. Because what's going to happen is that when an inspector goes in to check to see if the renovations are complete, it's going to be an all or nothing game, meaning you've either completed the item on the quote or you have not. And if they walk in and they see that you have installed double pane windows instead of triple pane windows, then you have not actually completed the item that is on the quote. And therefore you get none of the money associated to the cost of those windows because you actually haven't completed the quote. Which brings up another important part of this program, that you don't get the funds for the renovations until after the renovations are complete. Here's the order in which things happen. First, you put an offer in on a place and determine what improvements you want to build into that mortgage. Then you get itemized quotes for those improvements so the lenders know the value of the improvements that you want to add to your mortgage. On possession day, the lender will send your lawyer the mortgage funds associated with your renovations, and your lawyer is to hold on to that in trust until those renovations are completed. Next, you complete your renovations. To do this, you can use lines of credit, credit cards, any cash on hand. Some construction companies will even take a deposit up front, allowing for the renovations to be complete first and then be paid after. Once an inspector is able to come out and verify that the improvements have been completed as per the items on the quotes, then the lawyer is able to release the money that the lender has set aside for you for the cost of those renovations. And from there, you'll be able to pay off any of the lines of credit or the gifts or whatever you used to fund the renovations in the first place, thereby building in those future renovations into your mortgage. Now, there is no exception to the timing of this money. The lender is never, ever, ever going to give you those mortgage funds up front before those renovations are completed. And I'm sure that stems from a long line of people using the cost of these renovations, these mortgage funds, for things other than the renovations. The easiest way for the lender to make sure that the renovation money is being used for the renovations is to give it to you after the renovations are completed. There's two more things that I quickly want to touch on before we move on to how to fund the renovation costs after you already own the home. And the first is that by building in these renovation costs into your mortgage, it's going to have an effect on your mortgage payment. And intuitively, that makes sense. You're taking a much larger mortgage because you're building in these costs, and as a result, your mortgage payment will go up. The second, less obvious impact that this has on you is that it also simultaneously increases the minimum down payment that's required when purchasing the house. Let's say that you were buying a home for $100,000. In this case, your down payment required would be 5% or $5,000. But by adding in $10,000 worth of renovations, you've effectively increased the value of that house to $110,000. $100,000 for the value of the house and $10,000 for the improvements that you're adding. Now, your minimum down payment is 5% of that new higher value. So now, rather than putting 5% on $100,000, you now need to put 5% of $110,000. Now let's say that you already own the property and you didn't build in these renovations in advance because you didn't know that the purchase plus improvements was a thing, or maybe that you've owned the home for a long time and you're just looking to make some changes around the house. In that case, you have two options. You can refinance the property prior to doing the renovations, or doing the renovations and refinancing it afterward. But both may or may not be available to you depending on the amount of equity that you have available in your home. In order to refinance your property at any point, you need to have a minimum of 20% equity in your home. Or another way to think about it is an 80% loan to value, meaning the value of your mortgage is worth less than 80% of the value of your home. If you happen to have a lot of equity already built up in your home, then it's really easy to refinance up to that 80% loan to value mark and fund your renovations that way. Going to our previous example of the $100,000 home, if you already owned that home and only had a mortgage of $50,000 on it, then you could refinance that property up to the 80% loan to value. In this case, that would be $80,000. And use that additional $30,000 cash to renovate the property, or really do whatever you wanted with it. Now, if you have less than 20% equity in the value of your home, this is where it gets a little bit trickier. Because in order to refinance the property, you need to first do the renovations to drive up the value of your home so that you can refinance it later. Here's an example of that. Going back again to our previous example of the $100,000 home, let's say in this time you had an $82,000 mortgage. You actually wouldn't be allowed to refinance that property because your current loan to value is $82,000, and the most that you could refinance would be to $80,000. But by using a line of credit and boosting up the value of your home to $110,000, let's say the cost of those renovations was 10 grand, then after the renovations are completed, you refinance to 80% of that new value, which is $88,000. So now after paying off your existing mortgage, you're left with an additional $6,000 towards your renovation costs. Now obviously this doesn't cover off the full renovation costs in this case, but at least gets you something, allowing you to partially build in the cost of those renovations into your home. A bit of caution here though. Before taking any of these options, you should always consult a licensed mortgage professional, particularly one that has a lot of expertise in doing these kinds of mortgages before. Your renovation can turn into a complete disaster if for some reason you won't get the full mortgage funds that you thought you were going to get when doing these renovations, or you forget to account for some of the hidden or unknown costs that go into restructuring your mortgage, or worse yet, you don't qualify for the mortgage in the first place.